Well, it's a great question, and we've been in a low interest rate environment for so many years now. And there's no doubt that's been a tailwind for income-producing assets like infrastructure. So as expectations have started to shift, particularly given the strong growth that we're seeing, the vaccine rollout, concerns that inflation may be, that interest rates may be increasing, it's understandable that investors can see that as a headwind. But for us, it's important to look at what's really driving that interest rate increase. If it's being driven by higher inflation, that's where we think infrastructure assets are well positioned. And the reason for that is because of either the regulatory framework, the concession agreements they have, the long-term contracts allow them, in the majority of cases, to pass through inflation to the end customer. If, however, growth is being driven by real economic growth, then that's an environment where infrastructure and real assets do tend to underperform, particularly relative to higher beta general equities. Well, we estimate that more than 70% of our investable universe has the ability to be able to pass through inflation to the end customer. But let me answer your question and give you some practical examples of that. So firstly, utilities. Utilities typically make up about half of our portfolio. It does vary depending on the country and the regulator, but UK utilities, the regulator there allows them to earn a real rate of return. Now, the return cycle is typically 5 to 7 years, but what that means is that inflation is a pass-through to the end customer. And it's a very similar framework we have here in Australia. US, slightly different regulated assets, but it's more of a cost-to-service methodology. The utilities apply through a rate case, but again, you have that ability to be able to pass through uncontrollable costs like inflation. Toll roads, which Ed talked to, which we're seeing some good opportunities in. You tend to have more long-term concession agreements, typically over 30 years in duration. Transurban, a stock I know very close to your heart, Peter, is a good example of that. One of our larger positions in the portfolio. They have over 20 toll road assets in Australia and in North America, and the majority of those concession agreements allow them to pass through inflation to the end customer. And in some instances, it's even the greater of CPI and 4%. In other countries like France, it does vary. You have companies like Vinci where it's CPI times 0.7%. So you don't have that full pass-through, but you're largely protected from inflation. Mobile towers. Long-term contracts in place, price escalators are typically around 3%. But even in sectors where we don't necessarily have that explicit link, and freight rail is probably a good example of that, because of the barriers to entry that they've got, and because of the pricing power that they've demonstrated, we've seen prices increasing on average by around 2 to 4% per annum. You touched on it earlier, Peter, but 2020 was clearly a challenging year in so many ways, and it was a particularly challenging year for listed infrastructure. In fact, if you look over the last 15 years, it was only the second time that the asset class underperformed both global equities and bonds. So for us, we feel that a lot of the risks we've been talking around inflation, around interest rates, have already been priced in. Valuations are now back to where they were over their long-term historic range and sometimes even below. Balance sheets are generally in good shape and debt's been locked in at very attractive rates. So we feel that the asset class is actually very well positioned to provide investors with that income and that steady earnings growth for many years to come.
Maybe just wanted to touch more on the airport sector and why we're a bit more cautious. We think the market has priced in a very steep rebound in passenger volumes over the next 1 or 2 years, whereas we think it may take a few more. And on that basis, we think there's more downside risk in airport stocks in general rather than upside. Now, we think airport volumes will come back. We saw that in China in the second half of last year. In terms of their domestic volumes, they actually did come back to 2019 levels. And this is before there were widespread vaccines available. So it does show that there's good underlying demand for travel despite COVID. And we think as vaccines do become more widespread, like they are in the US, then we'll continue to see passenger volumes come back. But it will take some period of time, and that's why we're more cautious about where airport stocks are trading at right now.
I think staying underweight at this point, still makes sense given some of the long-term structural challenges. Good. It's been really insightful from both of you. Thank you very much. We're actually going to change panellists here. But thank you, Ed and Trent, for your time this morning.
Thanks, Peter. Thank you.
Our pleasure.
投资一定有风险，基金投资有赚有赔，申购前应详阅公开说明书与投资人须知。